think about how that little part right there, that's basically the 9:30 first opening price. And then any movement down away from that is to be viewed as Judas swing or a fake move. It's to get people thinking it's going to drop, keep going lower. And then all of this move here is the trend following portion of the move. It means it's all directional, it's all one-sided like this. And then at the close, price will come off the highest high and settle off the high. So we're going to take a closer look. Just remember, this little diagram represents one daily range. And I wanted you to anticipate the daily range starting at 9:30 here and where we close here at the end of the day. With that in mind, let's dig into the chart on a 5-minute basis. 9:30. So disregard anything to the left, okay? Just don't look at any of that stuff. Pretend it's not even there. You're focusing on just this candle right there. That opening tick that's right on that line. We drop, we go a little bit above the opening price, and then we drop once more, go a little bit higher, and we drop more, and we take out the low here and that low. See how those relative equal lows there? We drop lower, and then we started the whole idea of, as I outlined, we were one-sided. We were anticipating the buy-side liquidity resting above these highs right here. But while we were down in here, and while we were anticipating the run up, I was outlining how being a buyer, and if you want to hold into trades with a longer term target, where it makes you a whole lot more handles, a lot more pips, a lot more points, if you will. Buying at that opening price or lower when you're bullish. That point of entry right there is the institutional order for entry drill. And we rallied up above what? The new week opening gap high for this week. So Sunday 6 p.m. opening compared to Friday settlement price. That is your new week opening gap. So let's drop into a 1-minute chart. Here's 9:30 right here. We drop lower. We were looking for the new day opening gap. It trades through it, comes back up. We had an opening range gap in here. I'm not going to have that on the chart. I'm just going to go to the most salient points of running that low out there. And then I told you, I want to see it get above the new day opening gap here on the 16th. And I want to see it trade down. It does so there. And then we had this move with this candle. If you're looking for a way to hold on to trades, that part's easy once you've done these types of drills for months. Not a couple days, not a couple weeks, but for months. Now, I mentioned today that there's the Jackson Hole Symposium. Okay, I think day 1 is Wednesday, day 2 is Thursday, and day 3 is Friday. Because that's occurring, and it's on the latter part of the week, you have Wednesday, Thursday, and Friday. Treat it just like a non-farm payroll week where you have to trade on Monday. So as I outlined today, this is an institutional order for entry drill. It is the low risk buy. That means it should not come back below that, and it should just keep pressing higher. And we used the new week opening gap as support. They swept through it, cleared up some of the inefficiency into the order block right there. There's 2 of them, so you're using that price right there at the open. So that's a change in the state of delivery. Boom. Now we're rallying. It comes back down to engage that order block and upset any perfect delivery to the new week opening gap. Because remember, it can color outside the lines. We encourage that. We want to see things like that because it gives the opportunity to let the wicks do the damage. That's what you want to see. And then, because we were below the opening price at this institutional order for entry drill, I outlined time. If you get something like this position entry here, you do not strangle it by running your stop loss up. You don't try to keep moving it higher, moving it higher, moving it higher. But you do expect it around 11:30. That's beginning the lunch macro. It will start to drop against the existing movement that took place in the morning session, meaning here you go. It rallies up. And here is 11:30 right there. So at that moment, looking backwards, was it everybody making money on a long or everyone making money on the short? Clearly, everyone's making money on the long. So what is it going to do? It's going to seek the initial low that you're going to come to. Here's 11 o'clock. So right here's the price. So you want to go backwards and find the first low, but it has to form after 10 o'clock. Here's 10 o'clock. So yeah, we have a low down here. That's not what I'm talking about. Oh, well, we have a low over here. That's not what I'm talking about. Right here is 11:30. And you want to go backwards and find the first low, and that's this one. Did this low form after 10 o'clock? Absolutely. It's 11:17. So at 11:30, the macro will start doing what? It will seek liquidity that's trailed on that which has been profitable during the morning session. At 11:30, go back to 9:30. What has happened? The market's rallied. It's gone up. So the algorithm will seek what? The stops right below that low. Well, wouldn't you know it? Not only is it taking out that low, for anyone that's trailed their stop loss right below here, It's engaging the new week opening gap for this week. That's a reasonable expectation. It's going to gravitate and draw in price to cause more interest. So the lunch macro starts at 11:30 and it can go as long as 1:30. It could keep going higher and not have any retracements. But if you start to see it sell off, all you have to do is find the first low at 11:30, start going backwards. Where's the low that you're going to come to first? But it has to it has to happen to have formed after 10 o'clock. Why? Because it factors in any run that was created for silver bullet, any protraction in price action that's going higher. It allows you to get the obvious where everybody wants to jam their stop loss to, and that's this one right here. And that's exactly where it went to. And it also agreed with new week opening gap. See that? And then it rallies. So we had all this consolidation. We had sell side taken, and then we entered the 1:30 time right there. That closes the lunch macro. There's no more time aspect that's associated with going down to take the stops in this case. So now what is it free to do? It's free to start going in the direction from the early session lows and outlining that daily candle where the open is near the low and the close is near the high. Hold on to minimum 315. Why? Because that starts the last hour's macro. There's four macros in that last hour, but I told you it starts at 315 and that one runs to 345. Then you have one at 345 that goes to 4 o'clock. That's the one that we're going to go into and talk about now. So the market rallies up during the 2 o'clock hour, continues higher. When we looked at that little crude diagram that I drew out this morning, referencing the daily chart, the daily chart is basically what you see here, where it went up to the high, and then at the close, what's it going to do? It's going to settle off the high. So here's the close, here's the high, and all the way down here is the low today, and that was me telling you that's the low risk buy. And then submit to what? If you want to take longer trades, you have to set your mindset on the time. If you understand Power 3 as I teach it, the highs, if you're going to hold for bigger runs, the first and foremost thing is you have to submit to the time that's required for the daily chart or daily candlestick to form and close. So if you understand that we're bullish, that's we are indicating today down here. So for you to hold to the close, you have to hold into that last hour of trading, right? And then you also give yourself time when 345 comes. Right there's 345. So what happens is the algorithm will refer back to what? Levels on a daily chart, levels on a weekly chart, and any time frame cycling through less than daily all the way down to the seconds, and it'll cycle right back up. And all inefficiencies will be incorporated, all liquidity will be incorporated, and that's how the algorithm gyrates and moves up and down. And all of this run here, that is algorithmic. It starts at 345. What is it going to spool to? To what direction? This level, which is the high of the sell side imbalance, buy side efficiency on the daily chart, and the volume imbalance. Why? Because there's liquidity up there, and the market traded right into it here. That's what that pink area is. But this run here is absolutely algorithmic. Why is that happening? When are certain algorithms more prone to create big runs? Well, the last hour macro, obviously it starts at 315, and that one runs to 345. So in and of itself, you have that 30-minute window. And I'm looking for something that's going to cause the move off the high. So like here's the highest high of the day. And then you get this. That's the part that is the 315 to 345. 315 to 345 macro gets disregarded, and they use 345 going into the market on close. Market on close is that last 15-minute window. It's not 10 minutes. It's 15 minutes. It's 3:45 Eastern Standard Time to 4 o'clock. If it's earnings season, there will be an algorithm that fires at 4:01, and then you get this crazy run going into 4:15, and then when the regular session closes, the electronic trading goes bonkers, and then you see some wild stuff. This occurred because of what I mentioned today. The Jackson Hole Symposium, like I said, it can create volatility, and folks that know that, we're getting the opportunity to see a lot of volatility. They want to hurry up and get the run over with, basically.